If you ever feel like it's too late to secure your retirement, remember Henry Mah. This DIY investor didn't get serious about investing until his 50s, and today he says he has more money than he'll ever need. Oh, and by the way, that's after gifting roughly $1 million to his heirs already. It's an incredible story that he lays out in his latest book, and we're about to get a sneak peek from the man himself. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. And today we welcome back one of my personal favorites to the show, a DIY investor who's as generous with his time as he is knowledgeable about investing. He's built a retirement many Canadians would envy using his income growth investing strategy, and he's on a mission to help others do the same. Joining us is Henry Mah, founder of the investing blog, Your Ever-Growing Income. He's also the author of 5, that's right, count them, 5 investing books, including his latest, Income Growth Investing and Beyond. Henry, it's a pleasure to have you back on the show with us. Thanks so much for taking the time. Always great to chat.
Hi, Robert. Thank you very much for having me back. You sort of made my day.
Well, I'm glad to hear it. Thank you for the kind words. Henry, I got to say, I read the book top to bottom. It's a fantastic book. Lots of great insights in there. My only qualm with it is that you got some bozo named Rob Moise to write the foreword for this thing. What were you thinking?
Yeah. Well, after the first 4 were easy. When I got to the last one, I wasn't sure who I could approach. But I managed to find someone, and he wrote a great foreword.
Well, you know what? I was honored to do it and happy to do so, of course. It's often a grind to write books like this. I know I've spoken to a lot of others who've spoken to that. So what had you so motivated to punch out a 5th book?
Well, I had a fair number of requests. People ask me to, do you have another book in mind? And I'd given it a lot of thought. In fact, I started to write it with the idea that I would concentrate on retirement. Moving into retirement, the things you should look out for, the changes in attitude. But I found out very quickly that there are lots of books just on that topic, never mind what's on the internet. So I quickly gave up on it. And as I was sort of doing the introduction, I realized that there were things I could have expanded on, not only for the introductory section, but for the more advanced people that have read my book or followed my strategy. And that's what I ended up doing.
I mean, you're very thorough in the book. There's so many insights there, more than we're going to be able to cover in our conversation today, certainly. But we teased it off the top, this incredible portfolio that you've built for yourself that you feel is going to sustain you indefinitely in retirement. Take us through how you were able to accomplish something so incredible using your income growth investing strategy, sometimes also known as dividend growth investing. Just take us through how this happened.
Well, for me, we had gone through doing what most people do. We had some money to invest, and we just started immediately. We bought some stocks. We hoped that they would rise in value, and we would sell them, make a gain, and then turn around and look for another stock. And in fact, often we'd try to buy the same stock when it dropped, and we made some profits, but overall we weren't very successful. And that's when we hired a financial advisor, and we stayed with him for about 1.5 years. But we found out that we weren't doing any better, but managed by a financial advisor than we were doing it ourselves. And we were just fortunate enough to come across a blog or an article written by Tom Connolly, which discussed dividend growth investing. And that's how we got into it.
And we're going to talk about some of the finer points of your strategy here, but the idea obviously is just to invest in dividend stocks that are growing and reliably paying income over time through their dividends, and you basically get a snowball of dividend income growing over time. One of the knocks, though, I've heard on this strategy from others is that you need a lot of money in order to eventually live off of your dividend income. So I'm curious, you built this incredible retirement portfolio. How much money did you have to put in order to get it, basically?
Well, I think, by the time we were 50, right around 50, we were fortunate enough that we'd kept out of debt. So we didn't have any debt, and our savings amounted to probably in the neighborhood of $350,000. But most of that was tied up in GICs.
I mean, that's not an incredible sum of money. It's a decent chunk of change, but I mean, it's a far cry from what a lot of people think that you need. So incredible that you were able to pull this off with a relatively modest sum, let's call it. And it speaks to the power of the strategy if you do it right. So speaking of doing it right, let's hear some of your do's and don'ts for dividend growth investing that you've gleaned over the 30 plus years of your investing experience that you cover in the book. If you have a question for Henry, you're watching right now, and you want to get a question in, we'd love to hear it. So make sure you send them in to us. If you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box you want. And if you're watching on our YouTube live stream, just click on the link in the description that will take you over to our broadcast platform, and you can ask your questions there. All right, Henry, let's kick things off sort of at the beginning of the investing process in a lot of ways. Your first investing do is to prioritize holding dividend stocks in a TFSA rather than an RRSP. Why do you think this is a savvy move for investors who intend to one day live off their dividend income?
Well, we almost have to break investors into two groups. There's the high income earners, and then there's low to medium income earners. And I think the low to medium earners probably would have difficulty saving much more than, say, $5,000 to $7,000 each. For a family, we're talking $10,000 to $14,000. And for most people, that's a fair amount of money to put into savings, regardless of your age, unless you're up in your late 40s or 50s, where you're earning a great salary. So when we're talking, let's say 5 to 7 for a single person, 10 to 14 for a married couple, if you invest that in a TFSA, then your taxes will be, you just won't be taxed on any of that. And people are assumed that the reason you invest in an RRSP is because of the tax rebate. And they assume that, they're going to get between, let's say, $2,000 to $5,000, maybe $4,000. But if they collect that for 20 years, so we're talking, $40,000 to a maximum of $100,000 that they would get from the rebates. However, if they look at the other end of it, when they retire and they have to start withdrawing from their RSPs or from their RIFs, they're going to be withdrawing probably $25,000 to $30,000. And the tax on that will be more than double what they got on a tax rebate. So extend the taxes you're going to spend, and you're probably going to spend at least 2 to 3 times that on taxes over a 20-year period when you're retired. So by putting the money in a TFSA, the taxes will be minimal in your early stages, and when you're retired, there'll be no tax on it. Or even if you put some into a non-registered, the tax will be minimal. So that's really the big advantage of putting the money in the TFSA immediately.
Yeah, I mean, one of the things with an RRSP, of course, is that this is tax deferred, not tax free like a TFSA is. So if you do really well, like you did, Henry, you might be in a situation where the tax rate that you paid when you put the money in is actually lower than the tax rate that you're getting when you pull out the money in retirement. Now, obviously, that'd be a very good problem to have. But of course, if we can avoid taxes, we can avoid taxes. And why not, right? I mean, that's basically the logic behind avoiding the RRSP.
Yeah, you want to avoid the tax that you're going to pay in retirement. And, most people, they say that, well, maybe you won't be making as much money. But, any withdrawals from an RSP or a RIF are fully taxable, and they go over top of if you're taking Canada Pension, Old Age Security, you're moving yourself into a fairly high tax bracket. And, the reason I broke it into 2 categories, high income earners and low income earners, is that, there are people out there who can afford to contribute the maximum amount to their RRSPs for themselves and their spouse. And they also say they can contribute the maximum to the TFSA, which is currently $7,000 and $14,000 for a couple. Well, that could be up to $40,000 a year that they're putting into savings. And if they can afford to even add some to the non-registered, that means that they're saving maybe $50,000 a year. Well, that's not a typical person. A person can't normally save that amount if they have a family and if they're just living on a, let's say, above average salary of less than $100,000.
Yeah, that makes perfect sense. And certainly as someone with a young child at home, let me tell you, there's no way I could save that amount of money. So I think I relate with a lot of folks out there. Okay, let's say though that someone's in a fortunate position where they can max out their TFSA contribution room and they're looking for somewhere else to put their money. How would you sort of prioritize the order of operations, if you will, of accounts that you should be investing in beyond the TFSA if you're in a fortunate spot to be able to do that?
Yeah, well, obviously you want to take advantage of any company matching RRSP. And then after that would be the RESP or even the first home savings account. And then finally the non-registered account.
So the RRSP outside of that company match, definitely like lower on your list. So really interesting stuff because a lot of people, really like the RRSP. So here's a sort of counterpoint to consider for dividend investors. Let's get to your next investing do. And this is to build a portfolio of just 5 to 7 dividend stocks. You're regularly investing them over time rather than holding a really broad, diversified portfolio. This one's a little bit controversial. Like, talk us through why less can be more for a dividend investor.
Well, I don't know if it's less is more, but, you could identify better companies if you limit yourself to 5 to 7. When you start looking at 15 or 20 companies, then you're having a more difficult time to identify the best of them. Now, you can have 5 or 7 in your TFSA, have another 5 or 7 different companies in your spouse's TFSA, or even in a non-registered account, add 5 or 7 other companies. So then you would end up with a portfolio of 15 to 21 stocks.
So the idea here, though, is essentially to double down, if you will, sort of on your best ideas rather than casting like a super wide net and kind of diluting your income potential, I suppose. Is that a fair assessment?
Exactly. And maybe I'm going to answer one of the questions ahead of time, but, I think it's a pretty common belief that, diversification is the only free lunch in investing. Well, to me, that's, I wouldn't agree with that at all. Diversification to me means that you're settling for average. You're spreading your investments across markets and sectors, different international emerging markets, and with the hopes that if one does well, maybe the other one's not doing as well, and you'll average out. And, I'm not looking for average. I'm trying to get the maximum amount of income I can from the best companies that I can identify.
We're definitely going to circle back on that diversification point because that's a contentious one. And we're going to have a little clip that we're going to play from somebody else who disagrees with your take, and we'll get you to react to that. But before we get to that, I want to bring up an investing don't of yours. And that's simply don't sell the stocks that you pick in your portfolio. Why do you feel that a dividend growth investor should aim to hold forever if they can?
Well, it's not that I say they should never sell. I say that, they should probably be hesitant to sell. And if you've identified good companies that you believe will be around for 15, 20 years, it's very likely that one or two of them might run into some financial difficulty or debt difficulties over a period of time, but they're still quality companies. And it's just a matter of when they will recover from whatever's causing their situation, where it's debt or maybe it's, it's an economic situation that is affecting the entire sector. And, my preference is as long as they continue to pay and grow your income at a reasonable rate, then I would never sell.
But I could see a skeptic saying, well, Henry, sure, like the stocks maybe I initially picked, I'm happy with them, but there's this shiny new stock over here that looks really good. Why wouldn't I add that to my portfolio or maybe bump something else out and put this one in if I like it? Like, why sort of stick with the ones that you've got already rather than sort of trying to venture out and constantly add new and potentially better investments?
Well, I guess, if you're, let's say younger, 35 to 40, and, you're investing regular, you've got money to add to various stocks, you might want to look for some higher growth stocks that aren't on your list. But normally, certainly when you get older, I think that you should concentrate on the companies that you believe are the best, best companies within your own portfolio. And you might even want to reduce the number of stocks you own rather than expand it.
reduce. So, I mean, going the other way, that's an interesting take. Again, we're going to circle back to that. I just want to quickly point out, though, I appreciate you characterizing 35 to 40 as young because I automatically feel better about myself. So thank you for that. But let's get to that controversial don't that we sort of touched on a little bit. This idea that dividend investors don't necessarily need to be overly concerned with diversification in their portfolio. Last week, we spoke with a dividend growth investor as well. He sharply disagreed with that take. He says that diversification is key for dividend growth investors, especially in today's market environment.
There wasn't quite, in my opinion at least, the level of risk in the world then that there is now. And so how I have diversified my portfolio is I have bought 44 at this point ETFs and stocks. And the reason I've done that is to really shelter myself from single company risk. Because what I found in 2026 and in recent years is things just happen in our world. And there are risk factors that could possibly cut a single company in half. And so I don't want any single company in my portfolio to have risk that would take away from my goals of reaching financial freedom.
So, Henry, how would you respond to what Ian's saying there? Because I think that's a sentiment that a lot of investors would share. Things seem really scary, uncertain, volatile right now. Diversification can help essentially cover my butt if things go wrong. And we haven't really seen quite what we're seeing before. Well, what do you think about that argument and this idea that, holding a more diversified portfolio could help you out in those kind of scenarios?
Well, I'm hesitant to agree, but certainly there's nothing wrong with holding a larger portfolio. But I want to get back to the reason that I developed the strategy that I have followed for the last 20 years for sure. And the first is that it's simple. It's the entire income growth investing is a very simple strategy to understand. Secondly, we try to make it easy for people to implement. And the idea was that you do your evaluation up front, try to come up with 15 or 20 of the best stocks that you believe will be around for a long time, that are going to continue to pay and grow that income, and even then try to narrow it down even a little bit further. Secondly, or maybe thirdly, is that once you start investing in those companies, you almost are guaranteed that the income is safe. You're going to receive the income from the companies that you own. And even better, the income growth is predictable. It's not, once you've been invested for 2 years, 5 years, it's very easy for the individual to then realize, geez, I'm growing my income at 12, 15, 20% a year. And then probably the biggest issue, or biggest people that find the strategy worthwhile, is that they have peace of mind. They know that they don't have to worry about the market. They don't have to worry about what's happening in the economy. And they don't have to panic just because one or two of the companies aren't doing quite as well as they were before. The system works. Maybe there will be times when you don't earn as much income as you did a few years ago, but the income is still growing. And the reason I'm a little more confident on this is that, we've gone through this for 20 years. And we've seen some good. We went through the financial crisis. We've been through the recovery a bit, the COVID. And our income just continues to grow slowly and steadily. So, yeah. There's nothing wrong with diversifying if you feel you must, but I know that you don't need to.
I hear what you're saying, Henry, but if I could add some pushback of my own a little bit, friendly, of course. I think a lot of investors, particularly when they invest in blue chip dividend stocks, they have the sense that, my income's going to be reliable, it's going to reliably grow, and that sounds great until it stops working. Like BCE would be a great example of a stock that recently had that. I mean, it looked rock solid for a long time until it wasn't. Would that not be sort of an argument in favor of a little bit more diversification rather than going more concentrated in your portfolio? Because you never know what can happen. And particularly in the market environment that we're in right now, a certain administration down south seemingly is making decisions much outside the norm of expectations, let's put it that way, where you could get a curveball out of left field. Does that not speak to a little bit more diversification?
Well, it certainly might. but then you're back to guessing. You're making assumptions. You're trying to then, not necessarily time the market, but you're trying to make decisions by, let's get out of this one. Let's, buy this, or you start looking for new things. And once you get into that mentality of believing that, geez, maybe I should be switching over, or what if I should do this, or what if I didn't do that? So no, I'm hoping that I can show a chart where, we suffered a dividend cut just recently. And, when we get to that chart, Robert, I think I can, supply some support. Yeah, this is the one I'm talking about. And of course, this chart is showing our income, total income over the last 6 years. And if you look at the far right-hand side, you see the first half of that drop is where we sold off a large portion of our RRIF holdings. And just shortly after we did that, we all of a sudden had a dividend cut. And that cut came from a stock that was 13% of our entire portfolio. So when they cut the dividend, and it was a 50-some% cut, we took another hit on our income. And if you look at that chart, it looks pretty severe. But and that's, I think the upside there is 7 months. So within 7 months, by absolutely doing nothing, we didn't sell the dividend stock that got cut. We didn't sell any of the other stocks. We didn't add any new money to our investment. And yet our income recovered. At least we recovered the dividend cut portion, and it's continuing to rise. Now, here's a chart that goes back to 2007. So this is when we first retired, right up to 2025. And you can see the right-hand side there, that, I guess, squiggly section is the chart from before. So really, it's, the dividend cut didn't really affect our situation because we have such a margin of safety. And I call the difference between our total income and our expenses a margin of safety. Now, when we retired, we didn't have much of a margin of safety. But from that point forward, we didn't add a lot of new stocks. We had our portfolio picked out. I think we owned about 18 stocks. And, we did add some money for the first 5 years. But from 5 years on, we just owned the same stocks. We reinvested our dividends. I think over the 5-year period, we sold 2 stocks, and that was it. So income growth investing, and I don't necessarily own the best stocks. Let me say that right off the bat. But you can see that the income grew slowly and steadily, and it continued to grow even when we began to take out fairly large withdrawals from our RRIF account.
Yeah, Henry, I think if I was to boil down like everything about your strategy into a single chart, that would be by far the most compelling argument that I would use. It really is pretty incredible how quickly your income bounced back. So kudos to you, and a nice counter to the pushback there, I guess, on the diversification front. Let's keep things going, though. Another sort of related note that you feel, we're going to continue to knock down conventional investing wisdom here, is that dividend investors don't necessarily need to be particularly concerned about things like asset allocation, rebalancing, even the price they pay for their stocks to some extent. Most investors care a lot about those things. So why do you feel that dividend investors can largely look through these things?
Well, when you're dealing with one asset class, which is what income growth investing is about, you're only buying dividend growth stocks. And, the Canadian, my portfolio is 100% Canadian stocks. And, and I suggest that, if someone is in the accumulation phase, that they really do add some U.S. Stocks to their RSP accounts that they have it. They shouldn't add them to their tax-free savings or their non-registered. So asset allocation, well, I could narrow that down to saying, people recommend that you include fixed assets to your portfolio. And, I don't own any fixed assets. I never have. And I don't recommend that anybody who wants to follow the income growth strategy add fixed assets. I mean, why would you want to add fixed assets when your income is continuing to grow, as you saw in those charts? But if I had switched to fixed assets, let's say when I was 60 or 65, maybe I dropped from a 90% equity down to a 40% equity. Well, I doubt that I would have that margin of safety, amount of income to my expenses. I would probably be worried that I might outlive my savings. And I don't have that situation today.
I hear what you're saying, and I want to sort of pick on something that you're saying there, because one of your other investing do's is to set up dividend reinvestment plans, or DRIPs, on the stocks that you hold in your portfolio. To your point about not necessarily caring that much about the price, a skeptic might say that if you don't use DRIPs, you could basically selectively buy stocks when you feel that they're undervalued, maybe squeeze out a few more shares per purchase than you would otherwise, and that would help accelerate your dividend growth. Why are you a fan of DRIPs then, rather than doing something like that?
Well, first of all, I believe it's because it's automatic. You don't have to think about it. The dividends come in and you automatically, they get reinvested to buy more shares. But I do want to mention one thing, and this is probably something that I should have expanded on in the book more. I've talked about using yield difference to identify which stocks to buy. And of course, the yield difference is when you take the current yield and compare it to the long-term yield of that particular stock. And I've often said, or I have probably written in my books, that you want to avoid expensive stocks. Well, that's not quite right. I think that especially income growth investors during their 30s and 40s, even into their 50s, should always have a good portion, let's say 60-40, 60% average yield, average growth, and 40% in lower yield, higher growth stocks. And especially today, if you have a portfolio of 15 or 20 stocks and you do your yield difference, you'll probably find that a lot of stocks are always expensive. So if you avoid buying those, then most likely you're going to miss out on their growth that they'll give you in the next 5 or 10 years. And 5 or 10 years from now, or even 3 years from now, you'll look back at the price 3 years ago and say, boy, I wish I could have bought the stock at that price today, because it looks dirt cheap. And that's because those higher growth stocks, which are expensive today, will pride you with or give you that income growth in the future. So I say that for those more expensive stocks, allocate a percentage of your current investment dollars and buy them regardless of their price.
Yeah, certainly this is a little bit like pushing back against the buy the dip strategy, which sounds great in theory, but if you're holding on for so long, waiting for a dip that never comes, you just missed out. You were just sitting on the sidelines with cash. So I feel like that's what you're getting at there, and that makes perfect sense. One last don't that we're going to get to is that you don't feel that in dividend investors should necessarily look to cyclical industries, rather, like energy, mining, commodities. This one's a little bit interesting too, because some of those stocks have very juicy dividend yields. I could see that being tough to resist for someone who wants to live off of their dividend income. Why do you feel that holding these types of stocks can potentially backfire on an investor and really aren't worth the time?
Well, cyclical stocks really, their income or their earnings are subject to the economy. Something happens to the economy, let's say oil prices. Well, their earnings will immediately drop and they'll immediately cut their dividend. Now, certainly, once the economy recovers, they're going to start increasing their dividend at a fairly high rate. But you don't know how long that's going to take. And again, I go back to that, the reason that I developed the income growth strategy is I wanted to keep it simple. I wanted to make sure the dividends were safe. And you only do that by staying with the quality companies. Certainly, you might give up some growth, capital growth, but in the long run, you're going to come out with more income by sticking with companies that are, in fact, paying and growing their dividend on a consistent basis.
Right, and with those cyclical type kind of stocks, the risk, I guess you could call it, of a dividend cut on a down cycle, part of the business cycle, could be, I guess, higher, probably more routine, and so therefore kind of not worth the headache, as opposed to like other stocks that they might have a one-off dividend cut here and there, but it's much rarer, I guess. Is that fair to say?
Yeah, if you looked at our from 2007 to 2025, we've had 2 stocks that cut their dividend during that period. And of course, the first one was back in 2009. So from 2010 forward, we've only had one company cut their dividend out of the, 12 stocks that we've owned during that period.
Okay, so the proof is in the pudding right there. Henry, there are probably 20, 30, 40, 50 more insights that we could pull from you here. Unfortunately, time defeats us, but thank you so much for running through some of those do's and don'ts for us that helped you get to where you are in your retirement. We have a lot more to get to, including our live viewer Q&A, so if you haven't sent your question yet, keep them coming. But first off, I just want to flag to our viewers, if you're enjoying the show and you want to see more of content like this, then make sure you follow TD Direct Investing on YouTube, on Instagram, on Facebook. We're on all the networks there. You can scan the QR codes on screen to take a look at upcoming episodes that we have and a ton of other content designed to help build your investing knowledge. Let's get to our live Q&A though. Let's open the floodgates because there's many questions for you, Henry. You're a popular guy, clearly. Let's get to some of our questions. Let's see what we first have on tap. This one coming to us from David. He says, Henry, love the blog. How much credence do you give to using the Chowder score as a method to identify candidates for a dividend growth portfolio?
Well, I've never used it, so I can't give you an opinion on that.
Okay, there you go. Sweet and simple. Yeah, I've heard of this. I don't know too much about it. Not enough to opine on it, certainly. But okay, so not something that factors in for you. Let's get to our next question then. Who else we got? Francois is saying, your rules for deciding when to hold or sell a troubled stock. So this kind of speaks to that dividend cut conversation we were having earlier. Lay it out for us, Henry.
Well, I've always said that, if a stock continues to pay and grow their dividend at a reasonable rate, then I never sell. But, you have to make your own decision as what's reasonable. And I tried to, when I added my 5th rule, which was if the current dividend growth from the previous year drops below 3%, so they don't increase the dividend by at least 3%, then you might start to look at deciding maybe I should not invest more money in that company, or maybe they're running into trouble and I might want to watch them a little closer so that if they don't increase the dividend again the next year, and in fact, if it's lower, you might want to make the decision to sell and put your money back into a different stock.
Okay, a good rule of thumb there. Yeah, I mean, it is a very individual, call as to what you want to do. But I think the message here is not to necessarily reflexively get rid of a company after they sell their dividend. You have to sort of suss it out and see what the reasons were behind it and stuff like that. Let's keep going with our Q&A. What else do we have on tap here? This one coming from Lorelei. Dual citizens, U.S. Canadian citizens, are strongly advised to stay away from TFSAs because of U.S. taxes. What's your advice for people in this situation?
Yeah, I'm not versed on the U.S. tax situation, but if you're a U.S. citizen, then you have to claim your entire worldly income. And I think that the TFSA would probably be taxed as income because they don't recognize it like they do in our RSP.
Yeah, that's my understanding as well, that the TFSA is only treated as a tax-free vehicle in Canada. And so therefore you might want to look to an RSP, but then you also have the downsides that we talked about earlier in the episode. So a bit of a tough situation for dual citizens. Let's get to Susan's question. She's next on tap. Susan asks, what was the book or blog that you mentioned that got your dividend growth info from initially? This was from Tom Connolly. What was that one called, Henry? Just remind us.
Well, it wasn't a book or a blog. It was basically an article that he wrote. And in that article, he made the statement, if a company doesn't pay a dividend, don't buy it. And if it doesn't grow the dividend, don't buy it either. So those are the 2 sentences that caught my attention. And I couldn't believe that investing could be that simple. And then that got me looking into dividend growth investing much deeper.
It's amazing how 2 sentences were all it took for you to open the door to this whole other strategy that you developed and paid so many dividends for you. So I guess the lesson is, hey, Always be reading, guys. Always be learning. Good things can happen. Let's get to our next question. This one coming to us from Walter. What is your opinion on dividend-focused ETFs? Good question.
Well, I just don't like them. There's nothing that there's a, I don't know. I think there are some good dividend ETFs. I'll say that. But again, you're paying a fee. And the more money you contribute to those ETFs, the higher the fee. I don't care if it's a 0.2% or a fraction of a percent. Eventually, you're going to start paying $5,000, $6,000, $10,000 a year just for owning those ETFs. Well, take that $5,000 or $10,000 and reinvest it back into your own pocket.
Yeah, certainly the fees and the impact of them can add up a lot over time. Doesn't sound like a lot at the start, but it's not nothing, and certainly becomes quite substantial if you give it long enough time. That said, Henry, just I guess not pushback, but maybe some other clarification. Let's say I was a really busy and or lazy investor. Do you think a dividend ETF could make sense for somebody rather than trying to do the individual stock approach?
Well, I talk about a 5 and 10 stock portfolio, and you could. If you're a dividend growth investor, I'm sure you could come up with a list of 5 stocks, and every time you had money, just invest in those 5 stocks and invest in them equally. Don't try to pick and choose which one to add the money to. Just divide it by 5 or 7 or how many stocks it is, and that's it. And then reinvest the dividends automatically, and you'll come out way ahead. I think, I ran for 4.5, 5 years, I ran a comparison between individual stocks and a high yield dividend ETF. And over that 5-year period, the individual stocks earned between 25 and 35% higher income, not counting the fees. When I added in the fees, the work got closer to 40 to 45%.
That is a stunning gap. So interesting food for thought. Yeah, check out Henry's blog if you want to see more about that. I've read those posts, Henry. Really illuminating stuff. Certainly puts it into focus for sure. Let's get to James and Terry. They have a question for us. They're saying, what do you advise when stocks are overvalued like today? So obviously James and Terry feel that the market is overvalued, not sure what's coming next. What do you think about that kind of situation, Henry? Is that something that you even pay attention to at all, or you just keep on keeping on?
Yeah, I don't watch or worry about the, valuation. I just look at the stocks that are on my list or the stocks that I own. And that's what I was referring to earlier during our conversation. And let's say that one of the stocks that you own has a, overvalued or considered expensive. Well, if you believe that company is going to continue its higher growth rate, then add some money to it. Maybe not all of your money, but add a portion of your funds to those types of stocks.
There's certainly a bit of freedom, if you want to call it that, or peace of mind to some degree to not have to worry about stock prices, because most investors are fixated on stock prices in a lot of respects. Your strategy totally ignores that in a lot of sense. So there's a little bit of a rest for the weary, I guess. Let's get to our next question coming to us. This one from David. Given the current heights of the market, and since I've held many of these stocks for years, would you agree that maybe I should take some profit off those stocks, particularly since I'm in my 60s, sell some shares and buy GICs? What do you think, Henry? What do you think about GICs?
Well, I guess that's where we first started out with GICs. But, I have to go back to that chart, the last chart that was on the screen there, where we continue to own about 10 or 12 stocks. We do nothing but hang on to the same stocks. We reinvest a portion of the dividends, the portion that we're not withdrawing to live on or cover our expenses. And that's what causes that income recovery. We had a dividend cut. We sold a lot of stocks, but the income always recovers. And it recovers because of you're constantly reinvesting dividends. The companies raise their dividend periodically. Sure, maybe they're not raising it as much as they did in the past, but when you look at the recovery chart, it's doing great. And as long as your margin of safety, I want to harp on that a bit. If your income is higher than your annual expenses, then you don't worry about, that you're not getting the growth that you did in the past, or that one company cut their dividends. As long as you have sufficient income to cover your expenses with some buffer room, then just ignore everything.
Yeah, certainly if you're holding GICs, you're sort of locking in just that specific return, whereas at least to holding dividend stocks, you do have the upside potential. So if you can hold on, you could potentially get to that income growth, and that can kind of help you out in the long run. I understand your line of thinking there. Let's get to our next question. This one coming to us from Deborah. How much do you hold in money market or other places for emergency fund? Do you need one given your dividend portfolio? So we know, Henry, you don't like fixed income products. You're essentially like entirely in dividend stocks, but for your emergency fund, what do you do with that? Do you hold money on the side, or are you just kind of, as the dividend income comes in, that's what you're using?
We hold between $25,000 and say $35,000 in a savings account, and that's our emergency fund.
But you don't hold it in like money market or any kind of stuff like that?
No.
Okay, so you just prefer, I guess, the easy liquidity, I guess, of just being able to like pull the money right there and not having to go through
Exactly.
selling and stuff. Okay, I could appreciate that. Let's move on to our next question. We have May asking, are you dripping all your dividend income? Therefore, you get more stocks and not income from a tax perspective. What would you say to that, Henry?
Well, we're withdrawing, I guess, between 45 and 50% of the dividend income that we receive. So the other 50% or 55% gets reinvested automatically.
Even at the age of 84, you're still reinvesting dividends. You're still keeping it growing. Henry, I got to ask, why? like, why don't you just take the money out and go buy 7 Ferraris or something like that? Why do you keep reinvesting the money?
You got to remember, Robert, that the income wasn't that large in the early stages. Remember, back in 2007, when we retired, our income wasn't that much higher than our expenses. But the process, reinvesting dividends, adding a little more money during those early years, got that compounding working. And, by 2012, I guess, 2014, all of a sudden we had we were earning double our expenses. And the system feeds itself. And it continues. That's why we began withdrawing large portions from our RIF account and, just getting rid of that money because we didn't need it.
Okay, so no Ferraris for you. I mean, maybe we're different people here, Henry, but I think I would have bought at least one Ferrari by now. I don't know. That's just me. But in any case, that's all the time we have for the Q&A. We appreciate you fielding so many questions from our audience. There was so many more, but unfortunately, again, time beats us. But we appreciate you taking the time to field all those questions and to share your insights with us, Henry. It's always a pleasure to chat. Really appreciate it.
Again, thank you for having me on the show, Robert.
And we won't wait until you have a 6th book out, Henry. Don't worry. We'll have you on before then again, too, because there's so much more that we could talk about. Really appreciate it, as always. And, of course, to our viewers, we appreciate you guys tuning in, as always. Before we go, though, we have a special member of our team that we want to recognize. So Sarah Michaelis, our manager of content production on the client education team here at TD Direct Investing, she's retiring after today. Sarah, I think I speak for our entire team when I say we're happy for you, but we are really bummed to see you go. You are a fantastic manager, but an even better person. We will always appreciate how you made a point of recognizing a job well done and lending a supportive ear whenever it was needed. And of course, obviously you had a ton of fun with us here too, as you can see. You've been an incredible champion too of this show, and I'll forever be grateful for that. So Sarah, here's to a well-deserved retirement. Thank you so much for all the wonderful memories. Make sure you stay in touch. We appreciate you. All right, enough with the tear jerking. I told myself I wouldn't cry. I got through that without crying. I'm proud. But of course, Sarah may be moving on. The show goes on though. Here's what we got coming up for you next week. The RRSP contribution deadline for the 2025 tax year is quickly approaching, March 2nd, 2026. Mark your calendars. Financial planner Jacqueline Ozdemir is going to join us with her RRSP strategies that you can use to boost your retirement plan and save a bundle in tax before the clock runs out. So make sure you tune in to that. That's all the time we have for this edition of Inside Investing. From everyone on the crew, thank you so much for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.